Good afternoon and welcome everyone. On behalf of the ICMA International KSA Branch Council and the National CPD Committee, I am delighted to welcome all of you to today's webinar on IFRS 18, Presentation and Disclosure in Financial Statements, Understanding and Applications. This is Noman Ismail, your host for today's session, and I'm delighted to spend the next couple of hours with you as we explore one of the most significant developments in financial reporting, which is IFRS 18. Thank you to all participants who have joined us from across Saudi Arabia and beyond. Your presence reflects commitment of the finance and accounting professionals to continuous learning and professional excellence. As many of you may already know, IFRS 18 represents one of the most significant changes to the financial statement presentation and disclosure requirements in recent years. While the standard does not change how companies recognize or measure transactions, it fundamentally changes how financial information is presented and communicated to the stakeholders. I'm confident that today's webinar will provide valuable insights and practical guidance that participants can take back to their organizations. Before we begin, I would like to encourage everyone to actively participate. Please feel free to post your questions. Please feel free to post your questions in the chat or Q&A section throughout the session. We'll try to address as many questions as possible during the discussion period. Now, it gives me a great pleasure to introduce our distinguished speaker for today's webinar. Our presenter today is Mr. Riaz Niaz, fellow member of Cost and Management Accountant of Pakistan, qualified ACCA, having a diploma in IFRS. Riaz is a seasoned finance professional with over 15 years of extensive experience spanning healthcare, diagnostics, trading, and service industries. Throughout his career, he has developed significant expertise in financial management, IFRS implementation, ERP transformations, process automation, budgeting, and strategic business partnering. I'm confident that today's session will be both insightful and highly relevant for all participants. Please join me in welcoming Mr. Riaz Niaz. Riaz, the floor is yours.
Thank you very much and appreciated Noman and thanks a lot to the ICMAP for providing me this opportunity. Before we begin, I just want to double check with you, Noman. Am I audible clearly?
Yes, Riaz, you're clearly
Okay, nice.
audible. We can see your presentation as well. Please proceed.
Thank you very much. Appreciated. We will start with the one sentence that why IFRS 18 was needed. I would like each and everyone in our presentation currently joining us, please share your thoughts by messages or by sending your views that why IFRS 18 was needed, why IASB introduced IFRS 18, what was the loopholes or what was the shortcomings or what was the means I would not say misusage, what was the discrepancies between the requirement of the users of financial statement and the company's information being provided to them. So I just want to know from your side, first of all, by one line, that what do you think why IFRS 18 was needed? So let us start with this one. Let me know what is your thoughts, and I will just wait 1 to 2 minutes, and then after we will begin. So please send your thoughts why IFRS 18 was needed as per your point of view. Okay. As per Noman, changing a business dynamics. Okay, tamam. For uniformity and better understanding by Habib. For seeing companies profile from operation. from operational point of view. Okay. Due to avoid duplication of class of expenses, for better presentation and showing line items, better comparability, and better presentation. Profit and loss का structure standardize करेगा. Okay. Okay. For visibility and presentation, consistency in reporting. Okay, great. So I got the idea that what are your points and what are your thoughts. Okay, so let us see that as per my understanding, why IFRS 18 was needed. And after IFRS 18, what is the difference between the now onwards after the 1st of Jan 2027 and the previous IAS 1? Okay, so if I just continue by first point, the consistent structure. Before we were not having a consistent or a standardized line by line category, which we are going to have it onwards. Secondly, useful details. The aggregation and disaggregation concept is introduced in IFRS 18 to make it more useful for the user. The third is greater transparency by providing a management defined performance measures. So there are many points. If you just have a look on ENY, KPMG, Deloitte, PwC, they have written a technically too much point, maybe 5, 10, 11. Someone has written a 15 points that why IFRS 18 was needed and how IFRS 18 will be helping us to make it more accurate information, more useful, and more consistent and comparable. But I just want to mention one thing here. See, earlier it was not the user's mistake or it was not the company's mistake. Actually, the IASB had given itself a room that you can prepare your financial statements using IAS 1. And IAS 1 was providing the opportunity to all the auditors and to the companies. They were following as per their interests and they were providing the financial information using wherever they have a room. Okay, now the users of financial statement were not able to compare as clearly as they can clear after having this consistent structure. So if I just make it more simpler, what is consistent structure? You have a standardized categories now. I would say in a very simple rule, you have to follow one, two, three. You cannot deviate from two or one or three. No, there is a way you have to follow. What are these categories? We are going to see shortly. Secondly, the aggregation disaggregation concept has been introduced. Before you were using other income, other expenses, you are using a operating profit and you are putting a line above, below. Now there is no that much room for you. If I just use a correct word, you will not have that much room for you to play around. There is a clearly a lot of checks on you that even if you use that any operating profit, is it as per the described definition of the IFRS 18 or no? The thirdly, greater transparency means yes, there is a management defined performance measures. If you are going to use any term like EBITDA or adjusted net profit or profit before the revaluation gain or after revaluation gain on non-financial, whatever the term you are going to use in the management report, in the your financial statements or in your board of meetings or even your uh, communication with the users in the market, you have to give a reconciliation. So again, I would say that greater transparency. You are going to use a term, use it, but provide a reconciliation. How did you reach to that one? So then after, again, there is no room. So as per my understanding, there are three basically useful points which have made IFRS 18 more useful and it was not available before in IAS 1. Secondly, we have agenda today. What we are gonna cover? We are gonna cover the profit or loss categories which has been introduced by IFRS 18. Secondly, aggregation disaggregation concept. The thirdly, management defined performance measures. operating categories, financing categories, business scenarios. There will be some discussions on different business scenarios, IFRS 18 impact in insurance contract, and company specific discussions. Although these are the slides and these are the points, but we are gonna understand these all points with the help of the examples. So, what is my first point? Profit or loss categories. Uh, See, whenever you have a direction, whenever you have any clear idea that why you are doing something, you always stick to your goal. So here, I want you to please put a objective that after attending this webinar, we all must be able to understand minimum that what are the IFRS 18 requirement and how it is gonna impact our financial statements after the implementation of IFRS 18 into our company. So the first thing is profit or loss categories. What is profit or loss categories defined by the IFRS 18? There are now five categories. These are the standardized categories, and we have to use these categories: operating, investing, financing, income tax, and discontinued operations. I am assuming a one thing here that we all are professional. We all are working into our respective uh, sectors. Someone is working in a healthcare sector, someone is working in a banking sector, and we all are preparing our financials, and we always see our audited financials every year as well. But did you people see in your audited financial these all five categories? So the answer is no, we didn't see. We are gonna see these five categories onwards in every audited financial statements. This is the first thing. Second thing, I was not aware of the operating, investing, or financing income tax discontinued operations. No, we all are being a professional, being CMAs, we all are very much aware what is operating, investing, financing, income tax, and discontinued operations. I'm not going to discuss here in very much detail what is investing or what is financing. What I'm going to discuss after having these five categories into our financial, how our financials will be changed and what will be the impact after these five, although we will be giving a one or two line definitions. Okay, let me start with the Excel example. So Numan, is my screen visible? Excel.
Yes, yes, your I can see your Excel.
Okay, thank you. So here is one of the financial statements. It is basically taken from the Americana restaurant. It is one of the company which is dealing in a food products. So here is what IAS 1 presentation were looking like before. Like we were presenting our revenues, our cost of revenues, our gross profit, then expenses, and if there is any other income or something, it was there, operating profit, finance income, finance cost, profit before income tax and zakat expense, net profit for the year. To be very honest, this will not be our focus. Why? Because it is a past now. What will be our focus now? That is what is our future. So I would like each and every one of you to be with me here. I'll be taking you one by one how the practically financial statements will be changing considering our current IFRS 18 practices. Okay, so if you just have a look, there are now five categories in front of us. Okay, from the discontinued. Okay, so first of all, it is the operating categories which will be giving us the operating profit. The second is investing category that will be giving us anything, any income related to the investment. The third is financing category. The fourth one is the income tax. Although we have a zakat here, or we can say zakat if it is 100% owned by the Saudi company. The first fifth one is for profit from the discontinued operations. So each and every financials will have to carry these five categories into our financial statements. Okay, I will start with first of all the investing category. Why I did not start with the operating categories? Because as per IFRS 18, the operating categories will be a residual category. If something is not gonna fall into these all four: investing, financing, income tax, discontinued operation, if it is not as per the given definition of any of these four categories, that will be reclassified to the operating. Okay, so what is investing category? Let's have a one line definition. If you are in a business and your main source of business is, let's suppose, a healthcare, you are buying and selling a health equipment, medical supplies, you are in a trading business of grocery, or let's suppose Americana. Americana is selling a nuggets, burgers, and these all of things. So if Americana is going to invest into the shares, okay, or it is going to invest into the banks, there is a particular fixed income is coming to them, so that will be an investment income for them. Why? Because this income is a passive income and largely independent of their all operations. Their operations is not to make an investment in the bank. Their operations is not to make any property or earn the rental income. Their operations is to make the burgers, to make the nuggets, to make chickens or blah blah, and sell them. Okay. So anything related to the finance income, that will be having a separate category, and into that separate category we have to show the finance income. Okay. Then after we come into the investing category and as a finance income. Okay. If I say a little bit here, that will be more accurate. Okay. Just to make it more clear. Secondly, the Americana took a loan, and that loan they took it to support their operations. Okay, to support their operations. I will repeat my word: to support their creditors, the their operations, their working capital, to pay their salaries, to buy the material, or blah blah. So whenever we are going to have a borrowing, whenever we are going to have a borrowing, any finance cost we are paying over that one, that will be our financing category, and any finance cost paid on that one will be considered our financing category, number one. Number two, if I just make it more simple, if I just say interest expense. So will it be wrong? No, finance cost is basically an interest expense. Secondly, it will be considering only the interest expense of borrowing loan. No, there are many expenses which will be coming one by one, and we will have a look what type of financing cost or interest can come here in financing category. Okay, no issue. Let's move on. Now, financing category is clear for us. It is same like before, which we were doing. There is any difference? Do you see between this finance cost and this finance cost? No. It was coming before and it is coming now. So what is the difference? IAS 1 was not asking you to define a category here, financing category. After the operating profit, we were giving a finance income or investment income, same like before. But what is the change? The change is investing category. Before finance income, we have to show a investing category to clarify that how much investment income the company is earning other than the operating profit or other than the operations. So here is the two categories which we can see. Before, finance cost and finance income were clubbed together. Any company having a huge finance income or huge finance cost, that was offset, and we were not able to see clearly that how much is coming from the investment, how much is coming from the financing. Income tax and zakat, I'm not going to discuss this too much in detail. We all know that what is going to come here. Is there any change in that one? No, there is no any change. Any zakat regulation, same like before, you will be calculating your zakat and presenting here. But the only thing is that you will have a separate category, income tax and zakat, and that will be, let's suppose, showing here separately, which was not appearing a separate category before. Then after this, all together will be coming as a profit from continuing operation. And as per the IFRS 5, any profit from the discontinued operations that will be coming here. We all know that income tax and zakat, how it will be coming, and the profit from discontinued operations, any profit segment or business segment you have already discontinued and you are planning to sell it. We all know that there is no any change in the presentation. We were showing before also like this, but now IFRS 18 has asked us to clearly mention it into under this category. Okay, let us have a look on comparison. I did not discuss the operating category. I am going to discuss it now. The operating category means any business which we are sitting for. And like as an example, Americana is sitting, everyone knows it is sitting for the burgers and nuggets and these type of things. Secondly, the substance over form will work. It is not about that what is your legal CR is saying. It is about your substance over form. How you are going to convince your auditor, or how you are going to convince that what is your main business activity or no. Very simple rule. We all know that what is our main business. This is what our all resources, our all money, working capital is injected and working for that one. If Rabicana is here, all infrastructure, sorry, Americana is here, all infrastructure, all employees, all administrations, everyone is here to work for a cause. And that cause, we all know that is to produce the fast food items. So all the results related to this operations or main business category will be coming under operating category, and that will be driving us to the operating profit. Okay, now this was a small discussion about the categories. Now let's have a look. Operating profit, operating profit. Is there any change in the operating profit? No. Same like before. So Americana is not going to show any operating profit differences. Investment income or finance income, is there any change in the figure? No, there is no any changing figure. There is only a classification difference. They have to show a separate line, that investing category showing 15.5 million, let's say. Okay, financing category, no difference at all. Same like before. We have to show the same amount, same line, but we have to show with the heading financing category. Income tax, no change, same like before. They will go and they just have to add a one category, income tax and zakat. So whatever their category is coming here, amount they have to show, no change. So profit from continuing operations, I think this word have been used earlier as well. Whoever have a continued and discontinued operation. So any change? No change. Only whatever we have seen here in this example is addition of five categories. There will be now mandatory five categories, and that five categories will have to be shown in our financial statement after the implementation of IFRS 18. I will take a 1 minute break and just would like to know that my all users, my all participants with me. So I'm gonna ask now one question, and there will be a question after each and every slide. Each and every slide, there will be a question, there will be some discussion related to the IFRS 18. If you just have a look, selling and marketing expense, general and administrative expense. So do you think after the IFRS 18, if we are going to show as it is only five categories, so is this the only purpose of IFRS 18? Just to add the categories and that's all? What do you think? Like look at example here. Have a look. So what was here? The same is here. This is not gonna be a big deal. What do you think? These categories are enough, and these categories are the requirement of the IFRS 18? I just need an answer in yes and no. Then I will move further and I'm gonna open something in addition to that one. No, this was or this was not. So just give me an answer in yes and no in your chat. Was this only the main objective, only adding a categories into the financial statements, or no? There is lot more than this one. Just answer yes or no. No, no. mostly no mashallah صراحة يعني كي all معانا all are professional.
So
No,
just tell
no,
the
no.
people, just till the people are responding to your question, and I'm sure that most of they will respond no. But just before we go into more technical details, and if you just want to summarize IFRS 18 in one sentence for a busy CFO or finance director, what is the single biggest change that they should be paying attention to?
They should be paying attention to the standardization. Number one, there is a now standardization. There is a standard category they have to follow. Number one. Number two, they must follow aggregation disaggregation concept that we are going to explain in further. What is aggregation disaggregation means? There is some activities which are having a common characteristics. So the common characteristics as per IFRS 18 must be combined. The disaggregation, if they are different to each other, before we were clubbing into the other expense or other and G&A, and even though the nature of these expenses were totally different to each other, this is now prohibited by IFRS 18. So as a presenter, as a facilitator of IFRS 18, as per my understanding, now I would make it very short. There is a big check. What I understand, and we all are gonna see, there is a big check. We will not have that much room which we were having before to play, turn around here, there, left, right, make it up, other income, put it in the cost of sale. No, Habibi, that's all now. You cannot put everything in the cost of sales and khalas, tamam. No way. Yes, materiality will work. Materiality will be same like before. What was the concept of materiality? But aggregation, disaggregation is a clear example to have a control. Now, IFRS 18 also mentioned that even you are giving a detailed note, even in that detailed note, the principle of aggregation, disaggregation will be checked. The principle of management defined performance measure will be checked. So that we are gonna now discuss in second phase.
Thank
Okay,
you.
so
Thank you, Riaz.
I am sure.
Sorry, there are very
Yeah,
few questions as well, if you allow me to take
sure,
them.
sure, sure.
So one of the participant is asking if you're going to also cover the consolidation as well, or do you believe that is IFRS 18 is changing or impacting anything in the consolidation?
See, IFRS 18 is related to the presentation of financial statement. The consolidation we will cover, we will have a discussion, but the consolidation is purely a subject of IFRS 10. Like, for
Great.
example, I will just say one sentence, then we will move. There was a one company that was doing a consolidation before as per IFRS 10. So after IFRS 18, there will be a change in his consolidation laws, in his consolidation rule. So consolidation rule will remain as it is before. But what will be the change? Yes, of course. Like Maslan, I have a 10 companies. I was doing a consolidation of the 10 companies. What I was going to do? I was just adding up their revenues, their cost of sale. In the end, the figures were coming from the concerned entities. So that will remain same. But yes, there can be a complexity. If one entity is an investing entity, other entity is a non-investing, that I'm gonna cover in particularly in that slide. We have that one.
Sure.
Okay.
One more question here, and I'm sure that it is very common question coming across the finance people, that such kind of pattern which you were just showing to us in the Excel was already covered in the cash flow. So why the change in the P&L was actually required?
Yes, it was not actually covering the P&L. Na. Like, for example, the P&L was on accrual basis. And in accrual basis, we didn't know that how much we are earning from our operations, how much we are earning from our investment and financing. In cash flows, we were only interested to know that our cash is coming, and if it is coming that much, it is coming from which entity. For example, I am going to have a 10 million operating profit. It doesn't mean that 10 million profit I have a cash inflows in my bank. So cash flows was only objective to know if I have a profit. That profit, how much relate to the purely operation, how much related to the investing and financing. But here we are discussing accrual basis performance of the business. So that was the reason that we were not able to know the performance of the company in accrual basis. That is why they introduced these categories. Number one. Number two, these categories are not only the change in financial statement. In addition to these categories, they have changed a lot more. This is just a simple one. In addition to this one, they have added aggregation disaggregation rule, and that is the game changer, basically. Then after they have added a management defined performance, that is also another check to avoid extra room for the entities. No more play, no more play at all. So this is what. So this change is not specifically with respect to the cash flow. This is what my understanding. They have made many changes one time just to fulfill the need of the investors, users in all aspects.
Thank you,
Hope
Riaz.
I
Yep.
hope I answered the question. Thank you. Okay, let's move on now. Okay, see here. This is the second point which I am gonna cover here. Then we will move selling and marketing expenses. Expenses by no nature, selling and marketing, admin, these are our common practice we were explaining before and we were showing here. So what IFRS 18 says, if you wanna give your line item by nature, okay, it is good to show by nature. Nature means salaries expense, depreciation expense, amortization expense. If you are not gonna give, then even still you think that it should be by function. These are the functions or department. If you still wanna show by the functions, sorry, then you have to give detailed note why did you present here by function, and if we go by the nature, what will be the difference. And this nature, let's suppose these are the function. If you have a function 886 million selling and marketing, what are the selling and marketing inside this? One by one you have to explain in the notes, how much like salaries, how much marketing, how much depreciation, blah blah blah, whatever, how much advertisement, you have to give the detail. And this is not a new change. Frankly speaking, it was already there and auditors were already trying to give it detail. The second change, which I think that, see here, IFRS 18 under observation and shall be classified under either five categories. See here, this is very important. Before we were showing other income, other expenses. Now they have focused a lot. They said focus on materiality, focus on aggregation, disaggregation, and these all line items should be very clear. If we are going to show here other income and that other income items are club 1, 2, 3, 4, and we don't know this item is coming from where. Even the notes, I have seen practically this other income is here and the other income is in the notes. Now this is no more allowed. We have to give even in the financial statement. If my other income is 13.3 million, okay, this other income is coming from where? They want a detail. Even if you cannot give a detail in the notes, you have to specify why. You have to specify that maybe this other income relate to the investing activity. Maybe this other income is related to the operating and financing both categories. Maybe this other income is related to the here your main source of the business, which will we see in next example. So again, I will say only one thing. There is a big checks now, and after that checks, they want to disaggregate. Disaggregate means just separate the line item and distinguish it between the different categories, what is their purpose and how you have bring it here. Investing categories refer to the passive income source where transactional cost and initial cost. Okay, that's all, no problem. This we will discuss in coming example. Okay, financing and operating disaggregated. Okay. Uh, just have a look here in the summary, small summary, then we will go next. What are the five categories? Okay, their presentation we have covered here. Now we know operating, investing, financing, income tax, and profit from discontinued operations. The impact of IFRS 18 versus IAS 1 line by line we have seen. Okay, each heading is standardized so that easy comparability. You are sitting anywhere. Now you have to open the company's financial statement. No need to calculate manually how much investing income. This will be dropped down one, two, three line item. This will be dropping down. Yeah, it will be disaggregated into one, two, three common, and then you will come to know how much finance cost, from where it is coming finance cost, even on the face. It was there, but before it was not on the face, number one. Number two, it was always using a one line item, and in that one line item, we were taking a finance cost, and that's all. But now, what IFRS says, this finance cost, we are not asking you to put under a category, that's all. No, no way. This finance cost, we are asking you to check the nature of the expense, to go for aggregate, disaggregate. Maybe some part of finance cost related to your main operations, maybe some part related to your investing, maybe the some part related to your only pure financing. Sorry, maybe the some part related to purely financing, no other any activity. This one you have to now disaggregate. Okay, now I will move to my second example. And before that one, I need an answer of one question. I took a loan from the company, and with the help of that loan, I bought my fixed assets, my furniture, my working capital requirement. I am in a trading business, Americana. Okay, I am in a trading business, Americana. I took a loan, and after taking a loan, I am paying a monthly or yearly interest. That yearly interest is, let's suppose, 44,000 or whatever. Now, this interest expense, okay, is used to purchase the PPE, is to pay the salaries. This is used to pay the journal and admin expenses. So, what do you think? The part of the finance cost should not be reclassified as per the aggregation disaggregation concept here. I need the answer before we start the second example. I purchased, I took a loan, and after taking a loan, I am paying a yearly interest. And what did I do with that loan? I bought some PPE, paid some working capital requirements, salaries, some of the debtors, payables. I need an answer from all of you. What do you think? Should it not be classified into the operation as a part of aggregation disaggregation concept? I will spend maybe 30 seconds, 20 seconds. What do you think? It should be in financing activity, Fahad Ashraf. Okay. Okay. Finance expense will go to the investing activity and operational activity is very good. This is Azim Sheikh. Operating cost should be reclassified between the operating and investing. Investing portion will be cost to the PPE, shown as an interest expense in operating activities. No, this is a finance cost. Yusuf Ansari, Muhammad, yes, it should go. Yeah, it should be. This will be classified into the financing category. Habibullah, okay. Loan as financing, purchase of PPE as investing. Okay, Noman. Usually finance cost on asset being capitalized if it is qualifying asset. We are assuming it is non-qualifying asset for time being. That is why it is expense. Nasir Muhammad, finance cost. Okay, got it. Uh, the answer is this finance cost will remain as it is here. It will not be reclassified to the operating, even though we have purchased PPE, even though we have paid salaries, even though we have purchased the goods, even though we have done something related to the operations. Okay. Why it is so? The answer, it is inside the IFRS 18. IFRS 18 say, let's say you have a two companies, and both companies are doing the same nature of business and doing the same operations. One company took the loan and that is doing a operation. The other company did not take a loan. It was having a capital, so it is doing the business. Now, once you put you or charge your finance cost to the operation, what will happen? Your operating profit of the two companies will not remain comparable. How you will come to know that this company which was built to sell to sell the nuggets, to sell the items, and it is making a profit or no? Why? Because already you have charged a huge finance cost. So in that sense, the operating profit will not be comparable. To make the business comparability intact, they have said that finance cost, if it is used to take or support the operations, it will remain as a financing category. Let the investors or the financiers know that how much financing liability you have it, number one. Number two, and your pure operating result should be known to the company. You should not be crying like before, oh my goodness, I have a huge finance cost, see, that is why I am not making a profit. No way. Now you can make a profit and let the company know that you are actually a profitable company. Let me know if any confusion by your. Okay, let's go to the second example. BB Group, this is a pure IFRS example. Okay, there is a manufacturer, and manufacturer is doing a two type of business. He is manufacturing, let's suppose, furniture or something and selling, and he is also providing a financing to its customer as a main business activity. Okay. Now, what IFRS says, I just discuss with you a one concept here. See here, this is the, okay, this was our first slide, profit or loss categories. And what was my second agenda? Aggregation and disaggregation concept. Okay. After looking at the five categories, we have to see that how to organize clearly preserve materiality. What it means? It means is very simple. If I just not read this one, you have a similar type of expenses, you have a similar type of revenue, you have a similar type of business. That business must be shown as a combined. Like you are doing a two business, three business, four business, and if you think that they are in same in the nature, what you have to do, you have to just combine. You have to combine their nature of business into the same, so that your users of financial statement can know how much you are earning from which business, and how much you are earning from or sorry, losing from which business, and what is your other expenses like a financing cost, like a investment or income taxes. So this is the whole theme of aggregation and disaggregation, and it does not apply to income and expenses only. It applies everywhere. It applies everywhere, even to the cash flows. This is what we are gonna now understand in this example. Okay, you have a main source of business, that is a manufacturing and selling the item, and as well as you are providing a finance to the customer as a main business activity. Okay, now you have a two main business activities. This is IFRS 18 example, and here is the statement of loss, profit or loss as per IAS 1. Okay, if I just have a look here, what it is saying you have a one business line which we say gross profit from the sale of goods. Is there anything new? We all were doing same like before. We didn't change anything. Okay. This is what IS1. If I was preparing IS1, I will show the same gross profit. I'm not gonna change. Secondly, what IFRS 18 say? This is your main business activity. Under the main business activity, and your operations related activities should have a operating profit, and let the user of financial statement know how much you are earning from your manufacturing concern, how much you are earning from giving a loan to the customers, or giving a loan to the outsiders, or your customer, or your clients, whoever. Okay, so can I say that this business has two main business activities? Number one, sale of goods. Number two, provide financing to the customers. Okay, if you are providing a financing to the customer, to provide the financing to the customer, you need to take a loan. Sometime, not always. If you need to take a loan, you have to pay the finance cost on that one. And you have to pay the finance cost on that one. That finance cost you are bringing into the operational. result. Why? Because here it is under the operating categories and it is your main course of business. You are sitting here, your all resources are working all together for this cause. For one, sale of goods after manufacturing. Secondly, earning the interest income. Okay, so if I have a look, this one I prepared by myself, just hypothetically, that let's say we were in an era of IFRS one, sorry, IAS one, and under IAS one we are showing a sale of goods and something as an additional or immaterial amount altogether. We are not earning a too much, maximum 9,500. So what we have to do, we will be showing here as a net or maybe under the operating profit as a other income, and that's all. So now, as per the IFRS 18, first of all, this is your main course of business activity that will reflect here, number one. Number two, the interest expense, which was always coming here, which was always coming here whenever we see any manufacturing business, any trading business, we always club all interest costs, finance costs, all the interest expenses here, and there was no any thoughts or no any discussion just to reclassify above. Now this is not gonna be done. What we have to do, we have to check the business activity, and if it belongs to this business activity, then we have to reclassify here, number one. Number two, it will not be reclassified 100% for sure. We have to go for the basis how much loan we use for this purpose and how much loan we use for other purposes like a PPE. As I mentioned, we purchase investment property, we spend somewhere salaries payment, everything which IFRS 18 is covering in this example. Whenever you have a more than one main business activity, how the IFRS 18 will be reflected, number one. Number two, here selling, journal, and other operating expenses. What IFRS 18 says that, for example, if you want to show this all as per the function, still okay. If you want to show all this by nature, still okay. If you want to show this all as a mixture, some of them as a function, some of them as a nature, still okay. You are allowed to go for these three. But what you have to do, you have to prove that any objectivity, again, any objectivity, any useful information which you think that by function will help the user or financial investments to know more about your business, that is fine. Okay, now just here see income from the investment. And here what I did, I showed intentionally interest revenue related to providing financing to the customer under IAS 1. It was here after the operating profit, and now it is reclassified here under IAS 1. So your operating result is changed as well. Don't go by the amounts. Here the amounts are very small, but again, it is not about the amount now, it is about the standardization. If amount is small now, tomorrow it can be a big amount. They want to develop the practices, and that practices shall be very, very standardized practices. Okay, interest expense. Before, you never see too many interest expense here separately. Like Masan, you have an interest expense on borrowing related activity. You can have an interest expense on anything. Interest expense on borrowing for fixed assets or working capital. Okay, requirement. Let's suppose you fulfill this requirement. I say that total interest was more. You were having a 7,400. Now you are using this for this purposes, and you are showing here. And some of the interest expense on pension, this is IAS 19, if I am not wrong, are actuarial services. All related to expense will come here, and income tax will remain as it is. So what we are trying to cover here in this example, if you have a main course of business and you have a main course of business more than one business activities, in that case you have to go by the aggregation disaggregation concept, and in that concept you have to take care which expense or income will be reclassified into the operating, and which expense and income will be reclassified after the operating. So this was our first main business activity, and this was our second main business activity. Understood that after disaggregation concept, yeah, this one we already discussed now. The income is other than the main business activities. So this invest income, I am assuming that it is coming other than these two main course of business. Let's suppose you have a one property, you are taking a loan, you are taking a rent from there, and that is why you reclassified here. Okay, disaggregation concept. Finance cost before was being charged here total. Now you dismantle, you separate it, and you are showing more than one line item. Number one. Number two, you are taking one of the part from here and you are reclassifying as per their business activity, which is let's suppose for providing a financing to the customer. Again, same like before. Before moving to the other, I have a one question to my all participants. Can finance cost expense be charged to investment to investing activity? This is the second question. What was the first question? The first question was, can finance costs be charged to the operating activities if I purchase to support the business like a salary, like a PPE, like all these things. Now, my second question is, can finance cost or interest expense be charged if it is used to purchase the investment property or to do the investment? Let me know if the question is not clear. Please answer so that I can feel yes, my all everyone is with me and I am not alone speaking only. Until I will take a water and come back. Just please think about it and I will take 1 minute break. So let's have a look. What is the answer? No, the inter yes. Someone say yes. Habib said yes. Yusuf said no. Abdul said no. It should be yes, yes. Oh my goodness, mashallah. Too many people say yes. I want to find someone who say no. I am looking for that one. Now change your answer or think differently. Stop saying yes. Say no and think why no. Okay, I will ask Hashim. Hashim with me? Hashim is our KSA branch council secretary. I want Hashim point of view.
Sorry, Riaz, Hashim
Yeah.
left.
Okay, okay. Yes, Noman will give us his point of view. Yes, Noman, what about you? Just give you a thought. Okay, if I am borrowing, I'm borrowing a money, and that money is used to spend, to spend to buy an investment property, and that investment property is giving me now other income or investment income. So, what do you think that this should not be? Charge here as we are already charging here interest expense, some of them because it was our main course of business. So if this is the case, something is used to facilitate investment, then it should also be charged here. What do you think?
Not the expert, but I think it should not be here because this rule of being reporting within the respective line follows only for the primary activity.
Okay. Okay, I keep the answer till the end. And in the end, we will answer this question. Okay. And let us see what our listeners are thinking about it. A small recap before moving to the third example. IAS1 was very flexible. Now we have a mandatory categories: operating, investing, financing, blah blah. No mandatory. It was not a mandatory, huh? But now it is a mandatory. We have to have a mandatory operating profit. No mandatory profit before financing or income tax. Of course, now it is mandatory. Entity defined, standardized subtotal and reclassification, limited guidance on management performance measures. Yes, these two we are gonna discuss now in upcoming slides. So any other question in this example? If no, then we can move to one more example, next example. Okay, a small recap what we have covered in this example. If our main course of business activities is more than one, we have to show them in operating. We have to go by the aggregation disaggregation concept to align and to know the actual operating result. Thirdly, we have to go by the nature of the expenses more suitable. If no, then we have to give explanation in the notes why. The fourth one, we have to dismantle, integrate, disaggregate our nature of the expenses so that the users of financial statements can know that why we are paying and for what purpose we are paying. Before moving, I will leave two questions now for this slide. Number one, why finance cost cannot be charged here? If it can be charged, why? Even if it cannot be charged, why? Secondly, if this entity can calculate gross profit per nature of activity, then it can also calculate operating profit per activity. This is not a big deal. Then why we have not calculated here operating profit? Why we have calculated a total operating profit? We can calculate operating profit from sale of goods, operating profit from interest income, and then in the end we can say grow or net or combine operating profit. This is not a big deal. We have been doing. So do you think it can be done? If it can be done, why? And if it cannot be done, why? These two questions are for us. We have to answer at the end of the examples. Okay, let's move to the third example. The third example is a manufacturer that do not invest in assets as a main business activity, nor providing. This is a simple example. There is a one manufacturer, and that manufacturer have a revenue simply cost of sale. I just want to give you something here in this example. Other operating income, selling expenses, research, journal, goodwill, other operating income. So some of them, like Amazon research and development expense, it came by a nature. Okay, this I already explained. Journal and admin expenses, it came by a function. So goodwill, it came by a nature. Still, I am showing here other income and other expenses. This I already explained. Why? Because I took the data current examples. These are the current example. But if they have already implemented, I'll show you one France. France here has already adopted earlier. Now I'll show you the France year financial statement for half year 2026. They went for the early adoption and they did not show a single other or single other operating income or other expense. No way. After adoption, we will see if we have a time at the end of the presentation. Okay, this is possible. You can go by both, but you have to explain and give the full detail of this one. Secondly, here is I am not writing a categories again and again. I am assuming now we all know what is our categories, how many categories, and what is coming under what category. Okay, so this will not remain change. Here we have interest expense on borrowing and lease. Here we have interest expense on pension liabilities, IAS 19. This borrowing and lease, we all know it is coming the same concept which I discussed earlier. You purchase the assets on finance lease and that assets is supporting your business. Now what you are doing, you are paying the interest or you are recording an interest through IFRS 16 that will remain here. Again, it will not go to this exam because here they are just a manufacturer. Okay, income tax and the continued and discontinued. So in this example, there is a disaggregation concept which we already covered previously. This finance cost is on loan and the loan is used for main business activity. No, this is not used for the main business activity. Let's suppose it is used for the buying a fixed asset or it is a finance lease. That is why it is coming here. So expense by nature and or by function. Okay, but what is recommended by function? What sorry, by nature? What is nature? Salaries expense, like a depreciation expense, amortization expense. This is what recommended by IFRS. Okay, both presentation produce the same profit. IFRS mandate category based structure and profit financing income tax allow more. Very simple. Here you see the same result, but what is the difference? Here the finance cost was a one line item. Now you will always see into the breakup. This is the first change. The second change is that one you will see most of the time in the line item is always by nature. Okay, you will not see the third change, these type of lines. These type of lines you will not be seeing if it is material, even though if you see something that is gonna be explained very much detailed into your financials. So after this I have a PwC very detailed example, but before this, we will have a small recap of these three things, these three examples. Example one, example two, example three. If anyone from the listeners want to come and please explain, give a summary what you have understood, Ola, that will be highly appreciated and it will give me 1 to 2 minute break also. If anyone out of you wanna come and just explain, just recap whatever you have learned, whatever your opinion, what is the recap of this summary, the three examples, appreciate it. So Noman, if you can give to mic to anyone who wanna come, who wanna
Yes,
just
just kindly please raise your hand so we will make you unmute and then you can ask the question.
Ibrahim Anayat. I think Ibrahim Inayat. Ibrahim, do you want to come and give us a recap of these three examples, what we have discussed? Okay, anyone else?
Yes, I think he has raised the hand, and I
Who?
can see one more as well.
Yeah, yeah, please.
But I'm not sure if I have an
No,
access
I
to
think
them.
we have Shafiq. Shafiq, can you please allow just someone to come and recap us? Hello, yes, Shafiq, are you with us? Okay, automobile we will discuss. So maybe I have the right. Let us see who has raised hand. Okay, so Ibrahim, you are, yes, let me, 1 second. Yeah, try to speak, Ibrahim. Okay, you are. No, one second. Fahad. No, they have to be in the panelists.
I think the option of unmute does not exist for this session.
Okay, so
Let's move if
okay,
Shafiq
okay.
can help
No
us at
issue,
some
no
point of
issue.
time. Maybe we can.
So we will go to the now consolidated statement of profit or loss. This is, please don't think that this is a consolidation. No, here we don't mean a consolidation in that prospect that we have a different companies or portfolio. No, here we are just saying consolidation in this sense. All we have covered, all the examples and everything we have covered. This is what we are going to discuss. We are not going to discuss this in that prospector consolidation. Okay, I am assuming it is a one company and it is just covering all prospect of the this is by the way PwC. PwC has given a IFRS references and line by line explanation in each and everything. So they have a three type of business activities. Number one, revenue from constructing and designing a building. They are giving a loan, okay, to the let's suppose to the customer. Interest revenue on from finance lease. They are giving a lease, finance lease. Okay. The thirdly is here also the lease revenue, but that is related to the investment property. So there is a difference between this and this. Here they are separately dealing and here they are separately dealing. So they think that they have a three main line of business, number one, number two, number three. So in that case, what they have done, they have taken a gross profit three times. Here you can say gross profit from the sale of goods and some of the direct cost. And here they have taken a finance related expenses because they are thinking they are giving only the loan. Here they have a property related like maybe they are dealing with the properties they are giving on rent. So that expenses they are bringing here as a direct. So this is the first concept of nature of business and aggregation and disaggregation again. Secondly, if you have a look here, they have taken most of the things as by means, see, expenses, impairment, net foreign, derivative, and all they have taken as per the given IFRS rules, and they have shown as an operating expenses. Okay, now, I'm not going to discuss that fair value adjustment is coming here. It should not come here. No, it should come here because we have already taken the lease property or the investment property up. That is why. So I'm not going to discuss that one IFRS or IS one by one. I am going to discuss something else. Now, this operating profit is covering this whole business, and that is by three nature of the revenue stream items, finance lease, revenue from the property lease. Okay. So if you just have a look, here they have given each and every point of line that if it will come in operating, what is the sense? Why it should come in this line and it is coming by function or it is coming by nature. So what they have to do, specific nature disclose in the notes. If something they have shown by the function, they must explain in the notes what is this inside. Okay, this is not something new. We all know about it and we all have been experiencing. Okay, investing category they have taken something which is not related above main business, so they have gone by the share of profit or loss from associates and joint venture. Impairment on investment in associates, they have some impairment here. They are showing net income from investment in other financial instrument. I am assuming these all are not, they all are independent of their main course of business. Okay, this is something we have been now discussing. Interest expense on lease. Okay, although they are in the main course of business. Now lease they are in the main course of business, but they have explained here. No, this is the lease. This lease is supporting all the fixed assets only here. That is why they have shown here. So similarly, interest expense on employee benefit, it will always remain here. Net foreign exchange differences on financing item, it will remain here, okay, because related to the financing. Gain on extinguishment of liability, they have some gain that was not relatable to particularly one entity. Okay, here I just want to discuss a one point which is very common. What IFRS 18 says, whenever you have to distinguish or disaggregate the expenses, the revenue, if it is taking that much time, it is taking that much effort, which is not covering the, yani कि in a simple words, cost benefit analysis. If you are incurring a cost and the benefit you are not getting that much, then no need to incur that much cost, which will be useless, and the material information is, just do the comparison. But in the end, again, it will be with the auditor. If your auditor is convinced, if your auditor think that yes, this is very difficult, distributing, distinguishing, disaggregating is gonna make their life hell, so maybe he will allow you to go by this one. But again, then it will be a burden of proof on the auditor, not on you. So this is a good chance for all of us to start preparing from now. What is our business? What is our nature of expenses? How they are functioning? How they are working? What are the things we have to relocate to the financing activity, investing activity, operating activity, from continued operations, discontinued operations? This all we can start working from now to avoid any problems later on. Okay, statement of comprehensive income, that will not be changed. It is same as before. There is no any change. So I am just discussing the P&L, the five categories. I will look into this example again after discussing a one slide with you. Okay. Uh, what we are saying, there is a one more concept, management defined performance manager. What is this? I'm not going to discuss line by line. I'll just explain you what I have understood. You are working in a company and you are using some terminology into your reports, into your board meetings. You are especially a public listed company. You are using some terms to convince your investor that see, our financial position is much better, but due to the change in the revaluation gain or loss, our net result is very low. But this is not the case. You just see before this, let's suppose this year the market situation is not good in the KSA. You are not getting a money on time. What happened? Your bad debts, your credit loss is too much. Now the credit loss is too much. If I just go here and if I say your operating profit, credit loss will come here. Am I right? Your credit impairment losses, let's suppose here you are giving a credit losses, and this credit losses have give you a big hit due to the market strictness, customers are not paying. But you want to convince your customer, no, this is not the case. If you just, if you just go back, so you can say this is my adjusted profit, adjusted credit loss profit. Yeah, if you want to convince your top management, your shareholders, your board of directors, your investors that see, operating profit is okay as per financials, I am here, that is perfectly fine. But this item came due to this situation which will not remain always, and you want to convince them, then what IFRS 18 says, there is no any problem. You can use this term anywhere in the notes, no problem. Anywhere in the reports, no problem. Here it will follow the standardization. Okay, you want to say adjusted net profit of the credit losses, use it. Then give the give the reconciliation, okay, that this much amount is from line item number blah blah blah, and then you are again reaching to your operating profit, okay, of financial statement. Similarly, EBITDA. Now, for example, you are using here EBITDA, and this time you have some yani कि interest or depreciation more, because some of the assets you have huge investment, you have huge capitalization, that you don't want just your users to see this one. You want them to see something else. You know, you can use any adjusted line of operating profit. You think that if you add back your financial position, financial information, financial result will be more clear. You can use it. It is allowed. This is concept is called management defined performance measure. You can use a term, a subtotal of income or expenses qualifies only when every condition below is met. It means don't use any of these. This is already shown by the IFRS, let's suppose. You see, this is already used by the IFRS. For example, operating category, operating profit, investing category, they have used this, financing category, they have used this one. Okay, now you want to introduce a one term that is adjusted profit, and you want to say adjusted profit before credit losses due to the tough market situation. That will be a term you are using in your meetings, board meetings, shareholders meeting, and you want to use in your report also. So you can use in the notes, and in the notes you have to explain that if I use this term, what was the objective and how it is reconciled with my operating profit. You have to give a detailed reconciliation to match this one. And again, I will say it is a control. It is a control on you. Okay, a presentation of operating expenses we have already covered there. Okay, now I just wanna discuss something, small point. It will help me to cover my other examples. Otherwise, I'll not be able to cover my other examples because this is the what results we are gonna introduce here. Okay, interest and financing
Yes,
specific.
okay, if you allow me to take few questions related
Sure,
to
sure, sure.
financing and
Yeah,
interest,
sure.
I think this was the main point from where the participants are coming with the questions. So first question is about the finance cost related to IS 19. Where to be charged, whether in operating or financing?
No, it will be charged in financing. IAS 19, actuarial services you are doing and you are having any interest expense that will remain in financing, that will never ever come to the operating or investing or anywhere. Secondly, if you are doing a main power supply business, only this is the case, then it will be changed. Other than that one, it will always remain down in all the scenarios like a trading, servicing, manufacturing, banking. 100% it will always remain in financing. Yes, it will be changed whenever you are working in a main power supply business.
Okay, great. The second is about interest on lease, where it should
Okay.
go.
Yeah, interest on lease, for example, we have purchased some car. Okay, we are paying interest on that one. And now, what is my main course of business? My main course of business, let's suppose trading business. I am selling some trading items. So now this finance cost is helping my business. It's supporting my business. It will not come into the operating. It will remain in financing as it is. But yes, this is the business now. Let's suppose I am a kind of business where I'm selling items, you know, and I am paying that items which is, let's suppose, purchase on the lease. Okay, let me make it another way. Now I am in a trading business, I am in a servicing business, I am in a mixed business, trading and servicing. Wherever I am, any asset we purchase on the lease, finance lease, that will always remain in financing. There is only one condition, it will come up again in operating, that I am going to discuss now in detail.
Thank you, Riaz. One of the participant is asking a question that if a loan has been taken to finance the raw material, whether the incurred finance cost will be classified under cost of sales.
No, it will not be reclassified to the cost of sales. Why? Because we have discussed earlier that we want to make it comparability. Like Masan, there are two business. One business is working on loan, one business is not working on loan. How to make comparable result, how to measure their performance? We can only and only measure if we give them the apple to apple chance, same chance, same level of field. So that is why IFRS says we have to keep the finance cost below where we have to keep under the financing, so that their operating profit, operating result can be comparable anywhere with any company who is doing the same business.
Okay. One more participant is asking, where will be the interest expense on short-term loans will be charged, such as interest on on the LC refinancing.
Okay, now Mastan, you are doing a which business? Let's suppose you are doing a short-term loan and LCs you are dealing just to fulfill your creditors support. You need to import some item, you need to issue the LC. We have already discussed any interest, any financing facility will remain in the financing. Why? Because this is not your business until and unless you are in a business same like a bank, because bank is giving a money directly, until and unless you are a kind of business where you are dealing giving a money hard cash, same like I discussed one example, until and unless you go to the that level, your all businesses, all 900% your all businesses where you are not giving a directly hard cash to the customer, you will not bring your finance cost up. You will always remain your finance cost below under financing, whether it is a interest on the LCs, whether it is the interest on banking facilities, whether it is the interest on the long-term loan, blah blah, whatever.
Great. I think we can move. I
Okay,
think this is the
okay, good.
main questions related to finance.
Okay, now I'm just gonna discuss some small points. It will help us to be ready for the upcoming some advanced example. Okay, interest and financing, where do it belong? If we are dealing in a trading, manufacturing services, or servicing business, and we are taking a loan, borrowing to purchase fixed asset, working capital requirement, and general operations, financing. The category will be financing. Why? I already answered. An entity which purchased of investment property, an entity which purchased of investment property, okay, and that entity is using this one, that entity is using this investment property, okay, as a normal course of business, as a normal course of business. What it means as a normal course of business? Yani ke masalan, I have a rental property. Okay, I am yani ki giving a sugar me yani ki here the house is on rent, and I am taking a rental income from them. And I have only one business activity. This is my main course of business. So it should be classified in investing. I want to ask, is it correct? What do you think? Is it correct? This I write it by myself. This is I want to double check with my listeners. Is it correct? I am dealing in a properties business, and I am giving a properties on rent. I am taking their rent as an income, and I took some loan to buy a property, or you can say something, to renovate, to make some furniture, whatever. I am saying, khalas, I purchase ready-made sugar. Tamam. Now it will come into the investing or no? Is it correct? Maybe I am wrong. I just need answer in the please. Just say yes or no. I want to just check it. You all are like me or you are sharp? No, it is financing. Wow, Abid Hussain. I want to have a words with you, Abid. Yes, Asim say yes. Okay, yeah, I already write Yannick investing. Yeah, it is a plant of. Okay, any other answer? Asim say, Raja say no. Noman Ismail say no. It is operating. It is operating. Okay, it is operating. Okay. Khalas, okay. What else? What else? What else? What else? Investing, Shamir. Okay, guys, I will clarify for you. I'm sorry to write it wrongly. It will not come as an investing. I just want to check everyone with me or khalas yani ke done. It will not come in investing. There is no any difference between this and this business. What IFRS says, it says that again, if you want to compare two business, and under the two business, what is their direct business activity? Their business activities is to make the goods and sell. to make to produce services and sell. Here to make the sugar ready and to sell, they are selling a services. Voila. This is what my understanding also. They are selling a services. They are not selling anything. Okay. So here it is a services. So if someone is selling a services and he need to make something ready and he took a loan and he here you are saying financing, then what happened here? So again, it is a wrong. Sorry, by writing a wrong, I just wanted to discuss with you verbally. It will come also in financing. It will not come in investing. One more thing I want to discuss with you. No interest expense ever will come in investing. No interest expense will ever come considering this one in in investing. On which? Borrowing money. Borrowing money. You borrow money, you are paying an interest on that one to buy investment property, to buy anything, whatever. It is not gonna come in investing ever. Okay. But here the purchase of the investment property, for sure it is same like this one. Just think from the business point of view. Na, you are running a this business and here charging you will be benefit, and you are running a here business same like someone is charging a finance. How come? So I'm sorry for writing this intentionally. This will be also a financing. One loan used for both operations and investment. I am a company. I am selling burgers. Okay. I took a loan. Some of the loan I used to make a burger machine. I use some raw material, salaries. Half loan I use here. Half loan I use for the investment purpose. What I write is split on a reasonable basis. Is it correct? What split means on a reasonable basis means, let's say half half. Half will be in financing, okay, and half will be in investing. Is it correct? I think no. I already clarified. It is intentional. I write it intentionally. It will not happen. Actually, I just wanted to check with you people that see, again, what is the difference between these both? If you combine these both, this is coming. No way. An entity, one loan is used for both operation and investment. What IFRS says then? It is a see, anything you are facilitating the operations, khalas, your operations will always be as a apple to apple ground field, as a basic ground field, free ground field for both. You are not gonna charge to operation until and unless you are dealing with the hard cash business. Okay, number one. Number two, the investment category, we want to give to the investors that how much is your passive income is coming and how it is coming and from which sources it is coming. We don't mind how you are going to invest. This is not the concern here. What is the concern? If this business has already invested now, but how much their investment effectively is working. I'll give you one practical example. I have an investment. Okay. And I am putting my investment income and a finance cost together, and I am showing a loss here, big loss. Why? Because I have a loan. Until I finish the loan, how I will make some profit from the investment property. Okay. Then what is the difference between IFRS 18 and IS1? IS1 was doing the same thing, really. If you just have a look, IS1 was doing the same thing. There is no any change. If I am not wrong, okay, take it. It was doing the same thing. Then what is the difference between IFRS 18 categories, sticking, formalizing, and giving something to show what is you are bringing, regardless how you bring it here? Here we want to see how your investments are working. They are working efficiently or no. Leave it how you bring the money. This is not the area of discussion right now. So again, this is a combination of both. I will correct it, please. Here financing is correct. Here financing is correct. Here financing. Again here financing. Okay. Financing or insurance income statement is the main business activity. Okay. Now, interest expense is not with or not always on a borrowing. Am I correct? Interest expense can be on a finance lease. Interest expense can be unwinding of the IFRS 15 revenue. Interest expense can be on IAS 19 employee benefit. Interest expense can be on any other thing which we maybe I am not recalling now. So interest expense is not always on the loan. You took a hard cash and you are paying. It can be on, unwinding yani कि मसलन you want to discount it. So what will happen in that case? In that case, you have to treat differently. Okay, now let's discuss bank. If bank is using a funding, okay, and that funding is used to provide to the customers as a loan, this is the normal course of business. Here you are dealing a direct with the cash. So there is a cash, like Mastan, you are producing a services, you are producing an item. So there is a cost to produce the item. So that is why the bank has the money. There is a cost of money. That is why they consider it operating, and it is correct. Insurer, unwinding of insurance. Okay, what happens? I am sure you all familiar with this one. If we just discuss, insurance companies don't book their revenue and their expenses one shot. Like Masnan, you have a Bupa insurance or you have any insurance. What do you think? Insurance companies book directly revenue and directly cost? No. They have a system. IFRS 17 says you have to unwind the claim. You have to book proportionally. You have to book periodically. Like Masnan, every month there is a revenue part you will recognize, and there is a cost. That cost you will recognize. How? By first of all, you will unwind, you will discount it to the present value, and then you will incur extra provision, extra expense, interest expense, to increase your insurance unwinding liability. That will be in operating. Why? Because it is a direct requirement from IFRS 17. That is why it is coming as a operational cost of sales, and it will come there. Okay, now there is a ordinary bank. Ordinary bank took a loan, or insurance company, let's say insurance company took a loan, and they did not spend this loan on customers. They did not spend this loan on your financing. They make a one building, they make a renovation. I think I have already discussed this example many times. If you are facilitating your business, you are making your resources capable to facilitate them, you are gonna include this one in the financing category. Okay, operating categories as a main business. I will just say one word here. Operating category is your residual category. If something is not gonna be reported in financing, investing, or income tax, or from discontinued operations, khalas, that is gonna be your operating categories, and it is gonna be your main business. I want to ask you one thing. Do you think there will be any challenge to recognize what is our operating categories? Yeah, Anike, I don't think so. I have never seen in my life where a business is unable to see, oh my goodness, how I will come to know what is my main business activity. I don't think so. It's very easy. Why you are sitting here, what your all resources main objective is, what all main objective is doing here. Altogether, if you are earning something and you are putting your efforts, that is your main business operations. Okay, now let us have one example and then I will cover this slide. Okay, okay. Here, this is the IFRS example. DT Group is an investment and a retail bank. Let's say it is a investment company and also a banking facility. Khalas, I already discussed now. So what is the main source of business? Interest revenue. So interest expense will come here. Then there is no question why interest is coming here, because they are in the main business and they are giving a loan to the customer. Okay, and they have some fee and commission income and fee and commission expenses as a service agent. Okay, so that will be also their main business. Okay, what is this one? Let's say here one of them they are considering as an investment, and one of them they are considering as a banking. So if you go by the banking, I say let's suppose this one. If you go by the investing agent, it is the second one. This is all together here net fee and commission. Okay, net trading income. This is something net trading income, credit impairment losses, employee. depreciation. All together, after showing this one, they said it is our operating profit. Okay, this is the investment category. I am not writing a categories again and again. I am assuming we all are now familiar. This is the financing category and profit and loss, income tax and profit. I will recall my old slides previously into this one. Okay. Now, first of all, this interest expense is coming here. We all are clear, very clear. This is a main course of business by applying a rule of aggregation disaggregation. This is our main business activity. It will remain under the operating. Okay. First, second concept we studied, interest expense will be go by the aggregation disaggregation concept. That is why it is coming here and something is coming here. Okay. Thirdly, we studied interest expense on pension. Why it is coming here? Because this business is not related to the supply of manpower. That is, it is a trading business, banking business, wherever. So employees are just supporting. Employees are, see, just supporting the business. And as per IAS 19, it can be the time value effect. It can be multiple effect, geographical effect, many effect. This will help us to have the interest expense. That is why we are showing it here. The fourth one, we studied why we are showing here a separate line. Why? Because the business think that by showing here, we can cover our all operating aggregation disaggregation concept. Now they think that something trading, which is a separate part here. Okay, this both is related to the banking, let's say, and this is let's suppose for the agent. This net investment income, why is coming here, why it is not coming here? So I am assuming this net investment income is because they are working as a investing company, like Al Raji, investment. Al Raji is a bank, Al Raji is an investment. Al Ahli investment, it is also one of the subsidiary of Al Ahli bank. Every bank has always an investment company. So I ask you one question earlier, why they are having a net of each business line, one business line, why they do have a one consolidated operating profit? If they can go to this level, don't you think they can go up to the operating profit level? I think they can go. There is no any problem. If you ask me in my business, how much is salary related to this one? Very simple. I will go by revenue basis. Khalas. If you ask me depreciation, I can figure it out by fixed asset, sorry, module. I will go and check it out from there. Other operating I can. So again, I will ask this question: why they have a one operating profit? Why they do not have a Sarahan yani ki from management point of view, from business point of view, I want to know how much operating profit even I am getting, not only gross. So just give me, is it possible or no? Just answer in yes and no. I want to wake you all up before I answer this one. Before I answer this question, I want you to be with me. Yeah, please. Can we go up to the operating profit level? If we can go until the net income level, why we are not allocating the expenses here? Is it allowed? If so, or if it is not allowed, why? Yes, we can go by Sirajuddin. Okay. Abid Hussain, as an operation is a supporting to all segment, to show business segment. Gross profit is okay. Okay. Okay, yeah, it makes sense. What Abid said, it makes sense. Yes, we can. Difficult to allocate. Difficult to allocate. I don't think so. Very difficult. I don't think so. Nowadays, everything is possible. Difficult to allocate. Mm, okay. Mm. See, what is my understanding? It is not difficult to understand. I allocate. Sorry, I think it is not difficult to allocate. You can allocate it. But let's say if a business has now five categories. Okay, and you have a 5 operating profit. Tamam. And then you can show here as a net operating profit. So do you think it is easy to understand? Do you think it is logical, or in the end objectivity? What is my understanding, what I have read that one, if you want to show, okay, if you want to show extra some line item in the, you have to prove. There is a one line in IFRS 18 that say that you want to add something, a line which you think that can give to the users some objectivity, some more useful information, you can go for it. But again, you have to in the end explain in the notes 100% clearly that why did you do this one, what is the objective, and how users are getting more information that IFRS 18 rule were unable to provide. Number one. Number two, what is the standard category that will remain? This is there, always there. So anyone can open the financial and he can always compare. So this is what my understanding. You can do it. If you can do up to this level, you can go up to that level as well. But again, the objectivity. Do you think making it that level will be more useful? Okay. If you think no, then stick to this standard. Number one. Number two, someone asks for unwinding. See, now depends. You are working in which company? You are working in a bank. So in a bank, any interest on borrowing money, any liability, unwinding in interest expense, blah blah, related to the customers, related to the claims, related to this one will come here as a cost of sale. Any interest expense related to the यानी कि IAS 19, it is not directly related to the cost of sales or cost of money, or any other interest expense on lease. Let's suppose you have a lease asset, you have a building on lease, you have a cars on lease. IFRS 16, that interest expense will remain here and that will not be allocated here. Why? We already discussed that that will not be giving a true business platform to evaluate the two companies operating profit. Here this is cost of money, this is not a cost of money. It is helping your assets, and your assets are helping indirectly to your business. That is why they are not considering it into the operational part. The third thing, before I move onward, I asked one question earlier. Can investing category, can ever this investing category, okay, have, can this investing category have any operational cost be here? Can this investing category any in finance cost be here? So we got some answer, yes or no. This I want to explain it now. See what IFRS 18 says. Now I am, Noman, I am audible, right? Hello.
Yes, yes, you're audible.
Okay, okay. Uh, Now, this was the question before, that why this investing category is showing incomes from investment. Can I distribute here any interest expense? Number one, can I distribute here any operation cost here? So if can I do this one or no? As per IFRS 18, can I bring it here? So the answer is no. You cannot bring it here until and unless only a small cost, what they are saying, cost to buy, okay, at the time of buying, and cost to sell. Bus. That is a very minimal cost, transactional cost. You can put it here. But as far as the interest expense, any investing category, like Mastan, here, if I take you to the category to avoid any ambiguity, this is your category, investment income. This investment income will always remain as a standalone. It will never ever have any finance cost impact. Number one. Number two, it will not have your any operational cost impact. Okay, now someone can say, I have a dedicated investment department. I am paying a salary to their employees. Why should I not charge their salaries here? If I charge, then I can give a business more accurate. accurate performance. Now what should I do with that investment? So what IFRS 18 says that, see, here they are not interested to know how many employees you are hiring, how many salaries you are paying, how much you are paying. No. Why? Here the category name itself shows that how your investments are working. Like Masnan, if someone has a low investment, okay, and he has a big manpower, and he is trying to bring some manpower here to improve his operating result and showing they all are helping in investment, then it will be very difficult to figure it out. Oh my goodness, how many employees are working? One, two, three, four, maybe five here, 10 here. No, they stop this chapter and they say that if you have an investment income, that income will be dedicatedly here, whether you have a share, whether you have a short term investment in debt instruments, long term, blah blah, all income will be coming here. Any finance cost you incur to support this one will never ever come here, it will go here. Thirdly, any operational cost which you are incurring, actually it is a part of this investment department, still that rent, that expenses, everything will go here, it will not come here. Here they are just looking to see your investment performance. They don't want to open this chapter for time being minimum to khalas give you a room. That same like charge it, take the revenue and charge it wherever you want to charge, whatever you want to charge. No way. So hope I clarified this point. I will go to my example and I wanna share one very more important slide with all of you. Okay, I will repeat it. Whatever we discuss, we will repeat it again. I make some mistake here intentionally, and I will check with you. You are with me or khalas, or you are like me, yani. Okay, now trading business, manufacturing business, servicing. Okay, you have a normal trade of business. If the interest is paid on loan and the loan is used for the purchase of fixed asset, we already covered that will be under financing. I think there should not be any problem. You have the same business, trading, manufacturing, blah, blah, blah. You don't have a bank. If the interest is paid on the loan and that loan uses for capital working requirement, you are paying a salary, you are paying for the debtors, creditors, you are paying for salaries, you are paying for rent, working capital, blah blah, financing. Okay, trade, if the interest is paid on loan and any other operations is facilitated financing. Trading company and banking combined. I discussed one example with you. Trading company and a banking combined. Loan is used for investment property only. We took a loan, we bought our investment property. Investment is not our main course of business, it is an investment income. Now, the investment income is not a banking. Am I right or no? The banking is giving a loan. The trading business is not an investment, it is something selling a burger, selling a computer, whatever. Now, the purchase of investment for the purpose of IS 40, it will go to the financing. Before I move on, I need answer from you. Is this correct or no? Just drop your answer, then I will move on. Otherwise, I will not read only this slide. I need answer from all of you. Is it correct or no? Just one or two people, just say yes or no. I will move on one. Yes, yes, correct, correct. Yes, no, yes. Okay, so yes, no. Oh my goodness, Wallahi, Anike, you should not say no. Anyway, so it is yes, it is okay. Why? See, I took a property. Okay, property is for my investment now. I am not doing a property purchase and sale business. Tamam? It is my investment income. Now I am doing a trading business, burger business, whatever other business. If I took even for a trading business, I already discussed financing. If I am doing a banking business and if I use the loan in the banking business, okay, then it can go out up to the operating. But I am not doing anything. So, and I just explained to you now, investment income will not be touched or disturbed by financing cost. Please uh, memorize it. Memorize it. I will share with all of you the IFRS 18, this all presentation, and there is a link. Okay, you can read it there. Trading company and banking combined. Okay, if the loan is used for both purposes, operation and investment, interest cost shall be disaggregated into the best suitable allocation and financing. Please answer me. It is correct or wrong? One or two people, khalas, I will answer this one. Now be careful, huh? Khalas, be careful. There is something I put it here. You are doing a trading business. You are buying and selling something, glasses, waters. This is your trading business, and you have a banking, and you have a banking. Okay, you have a banking, and you are giving a, and both loan is used for both purposes. Now, is this correct or wrong? Just say correct or wrong. Wrong. Very good, Shabazz. Uh, Interest on right of use. Yes, it will always come in financing. Okay, yes. Shamir said yes. Wrong. Bank has the main course of business, then charge as an operating. Shabazz Ahmed, excellent. Abid Hussain, excellent answer. Very good. Okay, class. I will move on. Yes, you both are right. This is wrong. Why it is wrong? Because again, I said banking business, na. Banking business has a cost of money. That cost of money, like you are selling a burger or you are selling glass or water, you have a cost of this item. Same here in the bank is the cost of item is money. So it will go to the operation based upon the investment. I already shared one example. Banking funding used to provide a customer financing. Now, funding used to provide, mm, that is correct. Insurance company, insurance contract liability, part of insurance liability under, okay. I already explained you if insurance contract liability and you are unwinding it as per IFRS 17, that will go to the operation. Bank loan. mm, See, this is very important. You have an insurance company, you took a bank loan, and the bank loan is used to fulfill your working capital requirement. In this working capital requirement, what you are gonna do? For sure, financing. This is something you bought for you, sorry, paid to your salaries, you paid to your creditors, you paid to your yani ke rents, blah blah. Okay. Now I'm gonna insurance. Okay. Insurance unwinding already I discussed. Insurance companies all in operating income due to the agreement in the interest rate. Okay. Foreign exchange. I think this very easy. No need to discuss. But halas, okay. Any same concept will apply. Huh? Same concept will apply. Finance charges. Okay. Now if I go here, maslan. Foreign currency trade receivable and payable operating, foreign currency inventory operating. If you have a gain or loss on foreign exchange, depends what type of business you are dealing. But for sure, I think this is not something new, really. We are doing daily basis. You have a payable, and that payable, some gain or loss came on foreign exchange. You are dealing in operating, so there is not a big deal. Okay. Now the big deal is here. Foreign exchange on an investment asset. You have an investment category, you have an investment income, and that in that investment income is foreign market, US. Now, there is always a foreign exchange gain or loss, right? This foreign exchange gain or loss, now you have a shuffling up and down. Then what do you think? Is it correct? It should go because just now I said IFRS 18 say, please don't touch investment category. Let the investment category be as it is. Don't bring the finance cost. Don't bring the operational results, यानी कि salaries, rent, blah blah. Do you think foreign exchange on an investment, any difference up and down should be charged to investing? Is it correct? Let us see your. I think now you must be able to understand the concept. Just give me answer correct or wrong. Yes, it is correct. I don't know you. Yes, it is correct. Wrong. No, wrong. Wow. Please don't play like me. I am playing. I am playing intentionally. But you should be Sida. You should be Aniki giving me the whatever is your understanding. Someone is correct, someone is wrong. Okay, okay, one or two answer, please. Wrong. Okay, wrong. Someone say correct. Oh my goodness, someone is saying correct, someone is saying wrong. Okay, Shafiq with us. Shafiq, Noman, now Shafiq came.
Not sure.
Okay, how we will open the users? Uh, okay, attendance will come, brother. Attendance, no issue. Correct, correct, correct. Okay, I want to take some people with me here, foreign exchange on investment assets. Okay, I will not answer you. I'll give you a one yani ki one alternative just to think about it now. You always you purchase your investment from the US market, right? Okay. Now your investment market in the US is $100 today. And here you are in the Saudi Arabia or you are in Pakistan and you are recording at local currency because of the legal requirement. And then after you are not taking the impact of financing, sorry, of investment into the investment directly. Means for you are putting somewhere else, other income or something, you are putting somewhere else. After a 1 year, 2 year, 3 year, you want to yani ki sell it. Okay. You want to sell it and you want to sell it. So do you think that you will get the money based upon the currency in your local reporting, or do you think it you will get money based upon the foreign market? For sure, foreign market, there is no any ambiguity, right? Okay. Now, if you are going to get the same foreign market, so don't you think that the purpose of the IFRS 18 to give the true information about investment? This is what I said now. I said no need to bring the operating, no need to bring the financing, no need to bring the something or salaries, no need. You will disturb your investment. But don't you think if we do not show it with the currency which is currently going on, which is currently giving the real sense of the investment, it is $100, and $100 today in Saudi market is equal to this one. If it is a increase or decrease, don't you think by bringing it, it will give more useful information? I think it will give more useful information to the investment. That is why they kept it in investment. And this is logical. What, as per my understanding, this is logical. If you bring it into the investing categories as a gain or loss on foreign exchange due to the currency change, that is more logical. So your investors will come to know that how much you are gaining or losing due to the currency exchange difference. Why? Let's say one more point before moving to example. You are an investor, okay, and you are investing somewhere in a company, and that company is investing somewhere else, and they have a foreign investment, but due to the currency fluctuation they are not giving you any information here directly in the investing category. Did you achieve your objective? I think you did not achieve your objective. So that is why they have allowed to show this only in the investing category. Derivatives I'm not gonna discuss here, that is something else. Okay, insurance. Okay, there is a industry specific discussion, but I think how much time is left, Noman?
We're about to end our session, so I think if we can wrap up with, because there are few questions that are still
No.
unanswered.
Okay. Okay. See, before that one, I have some examples left which I wanted to discuss. But anyway, this we can see later on. See, there are something I don't know if I cover or no, but I want the participants to know about this one. IFRS 18 applicable to SMEs. So the answer is no. Okay, still they have a discretion to go by the IS1. Will investing activities include the expenses like salaries or blah blah? I think I discussed, the answer is no. Will the investing categories include the finance charges if the investment was done by taking a loan? I already explained this one, so the answer is no. What is the future of other income or other expenses? Other income and other expenses will be under pressure, and there will be a lot of yani ki checks. I am sure auditor is not gonna allow if amounts are material. Huh? I'm not discussing if someone has 100 real. This is for sure, even no need to discuss. Anything we are discussing here is about materiality. Investment companies and consolidation subject concept. Yeah, this is I have to discuss now. Will IFRS make it easy or difficult? Yeah, I will ask you first. Let me know your questions. After that, we will discuss these 2 points. Will IFRS make it easy 18 or no? And what about consolidation? Okay, let us go to the question answer, and then after we can have a look on this slide, and then we will close.
Sure, yes. Let me just take the questions that were asked by the panel, by the participants. I think the more focus remain on the financing cost and its presentation. Uh, okay, one of the question is about where shall we classify interest if it is unwinded by a business, not a bank?
Okay, if it is unwinded by a business, not a bank, it depends. You unwind it under which category? For example, if this is the one IS 19, it will always remain under the financing. If it was unwinded, for example, lease liability, and you are doing in a trading business or something, it will remain under the financing. If you are an insurance company unwinding is done on the insurance liabilities, that will remain as a cost of sales operating category. So again, it will depend that this unwinding interest is coming against which liability, number one. Number two, this liability is related to the means which category. If it is related to the operating category directly, like an insurance company, it will go up. Like an investing company, sometimes they have also some claims, insurance claims, so it will go up. But if it is related to something like in a business, servicing business, manufacturing business, trading business, then it will always go down under financing category. It will never ever be touched investing or operating category.
Okay. Next question is about if a plant and machinery is financed by the bank and the same is given on rent to other person, can a markup paid be classified under operating activity?
O- Okay, bank is giving on okay, so this is the bank is, see, bank is giving you the loan, right? Bank is not giving you something means bank is paying money to the, like a Toyota. I bought a car from Toyota. Bank is doing what? Bank is earning a money from the, so bank is giving a money to the Toyota, and they are asking from you the financing lease, right? Okay, as per my understanding, here it is the main source of the business. So here whatever is coming as a interest expense or something, that will go as a operating. How and what is my opinion about it? Like, I am a business, I am in a banking business, and what is my business? To give you the money, right? Or if not give you the money, give the money on behalf of you to someone. So you come to me, buy a car. So I'm not giving you the money, I am giving you the Toyota. So khalas, it means I give a money in a simple way, right? And I am earning from you. So now, if from my point of view, if there is any interest expense on this car or something, because I am a bank, if any cost I am incurring, I will not go by the car. I will think about that I give you a loan actually. So it will remain as an operating.
Okay. Next is about what if my core business is trading and some finance used for creating fixed deposit? It should be splitting to investing.
Okay, what IFRS says, see, in if you are using some of your finance for a fixed deposit, right? And then this fixed deposit is a passive income, you are not using your resources for this purpose, right? You have a trading business, your all resources are used there. So now in this case, any income is coming from the deposit is you are investing, and any finance cost even you incur for this purpose, right? So what you are gonna do, that will remain as a financing. It will not come in a operating or financing. Like Masna, you have 100 real loan. This is what I understood. Out of 100 real loan, you took 150 you invested in your business trading, and 50 you fix in a long-term business. Am I correct? A long-term deposit. And this long-term deposit is giving you some return. That return will in investing category, and any finance cost you are not gonna charge to investing or operating. Why? The operating already explained it is a trading, and the investing is not going to be touched or affected by any loan.
Okay, one more question here is about, it's an example. So they're saying based on our nature of business, the salaries and others are the material expenses. Currently, companies charging 80% in cost of revenue and 20% G&A. Is it agree as per IFRS 18, or the IFRS 18 require any change in this way of presentation?
See what IFRS says, you have to aggregate and disaggregate nature of expenses so that they can give you the true information, right? Okay, now you have a salaries. Now, if the auditor is splitting 70%, 30 or 80 or 20, they think that the gross profit you are earning, normally this is happens in gross and operating, right? Someone is charging to cost of sales, some percentage they are charging to the operating expenses. So
That is
this is
mainly where the revenue generation activities require human as well. For example, manufacturing.
Mm. Yeah, in manufacturing, I think it will become a part of the material cost also because there is a material labor overhead. In that case, it will become a part of the material cost because first it will go to the inventory, and then after once they are going to sell it, okay, it will be sold from there. This is
In
what my
some
understanding is.
in some industries like logistics, also the people involved. So how does you
Uh,
see this one?
yeah, in logistic, it is for sure. It is a direct cost. It should be classified up. See, particularly what IFRS says. IFRS says aggregate or disaggregate, right? Combine the same nature of expenses together. Now, all the salaries, if we go by IFRS 18, it will be combined. Okay. Once you combine and show all your salaries, do you think it is more logical to give the user true information or some of the labor working inside the warehouse, working for shipment clearing, inventory storage, and some of them are working in the office? So I think more logical will be to disaggregate, and this is what every auditor does everywhere. Directly related labor, they charge to the cost of sales. Indirect labor or indirect employees, they charge it to the operating expense. That is, I think, absolutely correct because it is giving a more meaningful information than putting a one line.
Great. I think there are many questions, but I will take just one last question because again we are running out of the time. So one of the questions is about, what about auditors' own difference of opinion at different locations? For example, one of the top five audit firm in Egypt way of recognizing the transportation cost in selling, and the other location in KSA recognizing under the COX. Who will force them to standardize this? So this is usually when you have group structure, and I think one of the companies in different jurisdiction or with different auditors. I think these kind of challenges are there. So, what's your opinion?
See, what I think the auditors have their own opinion, and I am sure, like, I'll give you one practical example. One of the auditors from the Big Four, they come to our company and they said, you are following IFRS 16 finance leads. Okay. After we change the auditor, the other auditor we convince, and he said, you are, khalas, you will not go by IFRS 16 finance, you will go by the operating leads. So, even see, this there are some what I experience. There are some clauses, there are some room for them to play or to give there. So if your auditor is okay to to present something in a COGS or in operating expenses, I think you should not be worried. Why? In KSA market, if the auditor is approving something, he is booking something, the burden of proof will be on the auditor, not on you. Number one. If you ask my opinion from the IFRS point of view, what they say combine the activities or combine the expenses of same characteristics. So if we go by this logic, and even we are a management accountant, anything you are incurring a transportation cost, normally it becomes a part of the inventory if you are in an inventory, right? Whenever you bring something from even out, the transportation is added to the inventory. Even if it is not added to the inventory, then it should be reclassified in a way that it should be charged to the cost of sales once you are selling the inventory. So this is a concept and it prevails everywhere. But again, in the end, final say is always from the external auditor, because they are the one who are the one to sign the report and to submit on the qawaim and to answer to the SOCPA or to any authority. How did you sign this report and based upon what you prepared?
Okay, I think this is last question from my side, if you allow. So, do you
Yeah.
see if IFRS 18 primarily as a reporting change, or should organization also expect implications for their ERP systems, chart of accounts, and management reporting structures?
Yeah, no, and it is very good question, really. From my point of view, what I studied during last 2 weeks, 3 weeks, it is from the reporting perspective change, number one. Number two, it is change from the nature of expenses and the from ERP as well. Now, for example, if you have already mapped, you have a GL mapping and all the GLs you have already classified. Now you need to revisit. Like, Mastan, this GL, I already took it as a mapping, and the mapping was based upon the function. Now you need to change the mapping as per the nature. Secondly, one of the expense you were reclassifying in the finance, it will remain as a core business activity. You have to reclassify to the cost of sale. Some of the expenses were charged to one category. Now you have to now you have to reclassify to the maybe two categories. You did not have a investing category before in your mapping. Now you have to add this investing. Or if you are having a category where it seemed like what IFRS 18 mentioned or no, I think it is a change from the reporting perspective. It is a change from the business accuracy results perspective, from the ERP as well. It will not be a big change, to be very honest. Like trading business, I don't think so. They need to be worry a lot. Manufacturing, real estate also. Yes, insurance and banking they need to review. But yes, if they have a more than one line of business and they think that that line of business has some implication in the allocations, that they have to revisit their mapping.
Great. So, I think last words from your side before we go for a vote of thanks.
Yeah, from my side.
Just if you want to wrap up your presentation,
Yeah, sure, sure, sure.
closing
Thank you very
remarks.
much and appreciated once again. I will say thanks to the ICMAP, thanks to the all KSA branch council and all the participants who listened to us 3 hours. I just wanted to say that I have not yet wrapped up. I was having a multiple examples, and because my plan was to discuss something. Uh, uh, I would say means the audited financials with you, some industry by industry discussion. And anyway, whatever we have discussed it right now, I can wrap it up in a way that you have to keep it in mind. Now, as per the IFRS 18, you have a five categories: operating, investing, financing, income tax, and profit from the discontinued operation. This is the first thing. The second thing you have to keep it in mind that the main course of business must be identified and reported separately. The third thing you have to be aware about the aggregation disaggregation concept. Something you have to allocate above, something you have to allocate below as per the given criteria. You have to be under the frame of the IFRS 18, if your management is using any terminology like EBITDA, adjusted net profit in your report, in your shareholders meeting, or in the communication with the investor or shareholders, they have to give the complete reconciliation in your notes. After that one, the last point is that once you are in any industry, just understand your business, how your business is affected by this IFRS 18. Maybe some of the businesses are affected a lot, some of the businesses are affected short with to certain extent. And last point, what I think that as far as the consolidation is concerned, as per my understanding, what I have studied, IFRS 10 is covering the consolidation impact. IFRS 18 is covering the only presentation. Whatever the presentations are coming in any financial statement, that will remain as it is, and that will be only clubbed and as a consolidation level. So there is not going to be a big deal change in the consolidation, even though we assume that the parent company is a investment company, but IFRS give a different definition. IFRS says that the investment company means not a company where you have a portfolio, you are dealing with all the businesses. Investment company means the company Saudi capital market regulated, some are regulated, so they have a different definition. So I would say no need to worry about the consolidation a lot. That will remain as it is intact. Only your individual company financial statements must follow this one. Before we move, one more change after the IFRS 18 change. Uh, yeah, cash flow. Before we were presenting finance cost and investment, dividend income in operating part. Now they say you have to start your cash flow or profit from operating categories. Then after you have to add back the non-cash item, and interest expense will always go to the financing. Dividend income on all this will go to your investing activities. Before we were having a leverage, that leverage is now finished. Why? If you are following your financial statements categories strictly, but you are not following the cash flows, then there was a mismatch. That is why they change the cash flows also, and they make it intact with you. So hopefully now after this IFRS 18, the users of financial statement, especially the investors, everyone will have a same ground to measure the performance of the different business more accurately than ever before.
Great. I think that was the end of the presentation. Thank you very much, Riaz, for such an insightful and informative presentation. On behalf of the ICMA International KSA Branch Council and National CPT Committee, I would like to express our sincere appreciation for sharing your knowledge and practical experience with us today. I would also like to extend my heartfelt thanks to all participants for joining us today and for your active engagement throughout the webinar. Your question and participation contributed significantly to the success of this event. Please continue to follow ICM International and the KSA Branch Council for upcoming professional development programs and learning opportunities. Thank you once again to our speaker, Mr. Riaz Niaz, and to all attendees for your time and participation. Wishing you all continued success, good health, and professional excellence. Thank you.
Thank you very much.